DailyFX BYOA contest for week 20. That's trading week of August 7th to August 12th, 2011. Pair I'm looking at right now is the Euro USD on the 4-hour time frame. As you can see today, Euro had a nice climb after the FOMC results. U.S. government's going to keep their interest rates incredibly low up until 2013. And really, at first, when the results were coming out, the market really just didn't seem to know what to do with it. Kind of just a lot of volatility bouncing around all over the place. And eventually, we just broke higher. And the equity markets broke higher in the euro, and risk appears to be catching a little bit of momentum here. Now, it is a little bit risky, in my opinion, jumping in on this risk move that we had today, or towards the end of today. Because we've just had such a steep decline in the markets all over the world. Major markets in a number of countries, Germany, Russia, South Africa, you name it, all of them entering into bear markets, and the U.S. technically is not, but we're very close, and we're kind of, in my opinion, it seems to be that we're heading that way. Today, with a 4% gain, I think it was 4.8% gain on the S&P and the Dow up over 430 points by the end of the day. It's tough to argue for a risk-on move right now, but I could also see it panning out. I think right now is a little bit too early to jump in on the risk move, but if you wanted to, I think the best thing you need to do is look for technical setups that support that fundamental view that risk is coming back on. Okay, so I think I've said this before in some of the other videos. You want to look for technicals first, and then look for fundamental follow-through. So I think, technically speaking, I think here's a pretty nice setup on the 4-hour chart on the Euro USD. As you can see, we have an inverse head and shoulders pattern. I typically don't trade this too often, but this seems like a very nice, solid setup, especially leading into this potential reversal we'll have in risk on trend taking or trading. So as you can see here, I've just highlighted. You got the head here in the middle, down there at the bottom, and you've got shoulder 1 on the left side and shoulder 2 on the right side. Now, I've highlighted in particular areas, in yellow, so you can kind of see. But this is just a standard inverse head and shoulders with your neckline, which is this descending trend line that you can see up here. So that would be the neckline for us. Now, the way you usually measure these things, okay, once you have a breakout, okay, you've got one of two things happening here. If we close back below this neckline, that invalidates our head and shoulders pattern. Okay, so you can just toss it out the window. It's really once you come back within that neckline and close within it, you can pretty much just throw it away. It's probably not a very good trade setup. What you do want to look for here, okay, is you want to look for a retest of that neckline and then buying long into the position. Now, what that does for you is it minimizes your risk as much as possible, okay, because you're putting yourself in a position where if it goes wrong, you're only going to lose a little amount of money, okay, because you're just minimizing the risk that you're taking it by trading it off the neckline, and you're going to maximize your profit if it turns out to be a solid, legitimate setup. So what I would look to do here is wait for a bounce off the trend line, or try to buy as close as you can, and then I would run it up on a buy here. Now, what most people don't know, I don't think everyone knows this, but there's a very accurate way of actually reading these head and shoulder patterns and seeing where price is eventually going to end up. So basically, all you need to do is take the the vertical height of the inverse pattern, or just the standard head and shoulders pattern. So you'd measure it from the head all the way up to the neckline, and so in that case it'd give us 250 pips. From there, you would measure from the neckline up 250 pips, which kind of results in us being up around 145.7 or 145.8, somewhere around there. I put this target here at 145.3. Just because that looks like the first logical, first trouble area for us. That looks like the logical first exit out of the position. But basically, technically speaking, it's pretty clear, So you've got a potential setup here where you're only going to risk a little bit of money, and reward-wise, you could really run this quite a bit. And we're only at 143.8. I mean, it wasn't that long ago that we were talking about 150. It seemed like it was only about 3 or 4 weeks ago that we were saying 150. So honestly, if this turns into an event where we just saw equities fall off a cliff, but they've kind of pulled themselves back, I guess you could say. They haven't quite jumped off the cliff. They kind of pulled themselves back, and risk is going to really take off here. This could be an awesome setup. Technically speaking, it's solid. Fundamentally speaking, I think it's a little bit early, but it's probably worth the risk if you get a good price at it and you can buy off that neckline. So this is just a setup I'm looking at right now. I'm not in a position yet. I am considering it. I'm just going to kind of see how this risk on behavior really goes. So that's about it. Good luck trading this week, and thank you for watching.